86% of U.S. renters would like to buy, but they can't. 86%, just 13% say they could afford it, but they're choosing not to. Now, to take this a step further, when you just look at the ones who can't afford it, only 46% say it's either very or somewhat likely that eventually they'll be able to buy. More than half, 54% say it's not too likely or not at all likely that they'll ever be able to buy.
Man, oh man. Rates. That's all we're hearing right now. You just gotta love a self-imposed recession, don't you? Imagine doing this less than 90 days before the election. I mean, the situation had to be pretty dire for this to happen now. I gotta tell you though, from a loan officer or a realtor's perspective, this isn't the worst thing in the world. Not even a buyer's perspective, right? I mean, the hysteria is going to push more realtors and lenders out of the business, which just means more for you. You know, the ones standing. But the big one is investors are going to find safer ground in bonds and the likes of high-yield mortgage-backed securities, and the Fed is going to have to drop the Fed fund rate, and maybe now they'll drop it even more than expected. I mean, maybe a half, but could we pray for 3/4? That would really be something. So between what the Fed is going to do on investors, this is like a double positive whammy for those looking to buy homes and, of course, those who are selling other people's money and real estate. I mean, I've already shown you the FHFA mortgage rate projection through the year 2025, like the next 15 months. They predict rates are going to drop about 1% over the next 15 months. But this new turn of events, with the stock market being treated like a red-headed stepchild by investors, might just mean an even bigger cut. Think about this. It's gotten so dire over the past couple of days that heavy selling in Asian markets triggered circuit breakers. Circuit breakers in Europe, stop. Just blow them up. And as a result, the stocks, STOXX, dropped by 2.7%. And that, of course, made its way to the United States markets, which actually triggered the Asian sell-off in the first place, which temporarily shut down the European markets. Meaning this just isn't happening to you. What's happening in the U.S. housing market is affecting the entire world markets. But from a realtor or a lender's perspective, in short, your problem is affordability and less but still inventory. So this little micro meltdown is going to actually help you and your buyers. So don't lose the opportunity to idleness or hysteria. Focus, Padawans. Focus. And more proof, not a day too soon for a little recession that's going to help housing, because a CNN study found that 86% of current renters in the United States can't afford to buy a home. And over half of those Americans say that they don't think they'll ever be able to buy a home. That's sad. So chin up and put your work boots on. We got a recession coming and the Olympics are finally almost over. Things ain't that bad. Now, in other news, according to CNBC, the best FHA mortgage lenders in the entire country, that means you too, are in this order from top to bottom. Number 1, the best FHA lender in the country is Chase. 2 is PennyMac. 3 is Rocket. 4 is Guild. 5 is Cross Country. 6 is Fairway, and 7, of course, is Guarantee Rate. Now, a lot of good lenders in there, but clearly people who actually write loans were not part of the brain trust that came up with this list. And I only say that because every loan officer in the country, I mean all of you guys, if we're going to be honest about this, they know that mortgage brokers are going to have the lowest overall interest rates. And I've got to assume, well, maybe people just don't want to have low interest rates anymore. Who knows? I never would have guessed that, though. Now, moving on to the big story for today. Now, we told you just a few weeks ago that HUD and the FHA are expecting a huge default market in the very near future. Now, nobody told you this but us. Now, we based this on a press release that said FHA is changing a rule, a little known article that nobody was talking about, changing a rule on defaults that will allow them to not have their mutual mortgage insurance fund, their MMI account, attacked by investors and servicers when these defaults start to occur in large number. Now, I looked at this and I said, oh boy, this is not what it appears to be. They think we're going to have a big storm, a tsunami of foreclosures in the near future. Well, we just got more anecdotal proof that that is the case. FHA aims to allow remote communication between defaulted borrowers and lenders. They want defaulted borrowers to actually talk to the lenders now. Communication is the best way to avoid default, and no better form of communication than actually speaking with the other human being who defaulted on their loan. Now, HUD says, and I quote, "This final rule updates HUD's current regulation and requires mortgagees to meet in person with borrowers who are in default on their mortgage payments. It requires them to meet in person. So do they know something that we don't know? I mean, probably. They have better economists than you and I do. They know those that set policies that affect foreclosures. Hell, they're the ones who set policies that set foreclosures. So this is just a nail in the coffin of a recession and a foreclosure tsunami that's in the near future. Personally, this doesn't bother me in the slightest from a loan officer's perspective. Some hear foreclosure, and what I hear is inventory, affordability, and my buyers are coming out of the woodwork, and we are going to fix the problems that are going to be created through this foreclosure wave that we have in front of us. These are going to be hot times for loan officers and real estate agents, so make sure you make the best of it. Thanks a lot.